Well, it's good to be with you today. This is Buddy Crum, Dr. Buddy Crum. I'm glad to be here with Don Wells again. Always like to be with you, Don. Let's talk about investing. Help me invest, right? That's what
Help
we
me
need.
invest. Helpmeinvest.com. And for those that are listening, that's one of the things that we've put together as a tool, a resource to help investors that are looking for some guidance. As always, we remind people we're not selling products. We don't have something to sell you. We're trying to help you get your money working for you, because one of the things that as you begin to invest and you see things grow, you'll begin to understand how powerful compound interest is and how it can aid in helping you to build wealth.
You know, one of the secrets of success, if you want to call it that, of investing, is to be able to start off with a base of liquidity and then build into that. As you go up the scale of risk, you're able to look a little bit higher in your risk. As we know, people who are very wealthy have the opportunity to invest in corporations and stock before they become public.
That's right.
You know, you hear somebody advertise, I bought a stock at $10 a share, now it's $200. Well, most of them, it was not public when they bought it, but they were able to buy thousands or millions of shares. So anyway, we've got to start with, and I know there are certain ways that you can diversify your portfolio, and certainly going to professional managers is one of the ways that you can do that. Very few people have the ability or the inclination to study the market consistently to buy individual stocks. And I know you've done that with your clients, or that you did many years. So tell us a little bit. We know about mutual funds, and they're certainly an opportunity to spread your risk. There's some things about mutual funds that we need to know in terms of which ones to invest and so forth. But you know, a lot of people, I've heard you recommend index funds, Don, and you might tell people a little bit, what are index funds?
No, that's a great question, Dr. Crum. And we've had people that have asked that, and I thought it's a good time for us to take just a moment here and kind of explain just kind of some of the basics with that. Because, you know, oftentimes for a smaller investor getting started in investing, you know, if you go to buy a share of something and it's $1,000 a share, you get one share. That's not very diversified, and so if it goes up, that's great, but if it crashes, you lose your money. So in investing, we want to make sure we diversify. So mutual funds, of course, were invented and designed, created for smaller investors, because you can buy kind of the fractional share concept of you know, investing. The problem many times that I, as an investor, have is that the fees are much higher, and the performance is not always at a level that we could get. So while we sometimes recommend mutual funds if it's a smaller investor, index funds have come along and given opportunity for somebody to invest in them. So what is an index? Well, if you've ever watched markets or the TV and you see the S&P 500, the Dow Jones Industrial Average, there's many of them. Many of them are not as well known. The Russell 2000. It's really a conglomerate of companies that they have. The S&P 500, 500 different companies that are put into an index, and it's really a benchmark. That's what we're shooting for. So can we outperform that, or do we underperform that? So by buying into an index, and there's many different index companies do that themselves. They create indexes, which is just really sometimes hundreds or thousands of stocks that you can buy into through this index. Sometimes they do it through ETFs, again, which is sometimes fractional shares. So you're buying into a diverse group of different stock companies that allow you to really participate in the market and capture the market of these companies while spreading your risk at a very low cost. So many people there's the different index companies that have come along. Vanguard's probably the most well-known. They've been around since the 70s. But what it does, and they've got a great fund called VTI, Victor Tango Indigo. It's their, kind of their world fund that they use for, a variety of stocks. What you're doing is you're buying into literally hundreds and hundreds of different stocks. And people say, well, yeah, but, what about the good stocks, the winners? Well, if we could pick the winners, again, you've heard us say so many times, I don't believe that you can consistently pick winners. It's just not something that most even managers can do. It's very few managers ever have the capacity to outperform the market long haul. So the reason that we like indexes is because it allows you at a very small fee for a very small investment to get great exposure into all the market. You're getting Google, you're getting Facebook, you're getting all, not just tech companies, but you're getting all the way across the board. Because what's important in investing is you've got to have that inverse relationship, as we say sometimes. That's how we measure risk, is how do stocks, it's called correlation, coefficient correlation. How do they correlate to each other? If one goes up and one goes down, that's a good correlation. If everything drops down, it's not good. So it gives you a great exposure to the market, with great correlation in your stocks at a very small price. So fees are more important than most people because they don't see them, understand when it comes to investing. You don't want to have high fees. And so it's a low fee. It's a great way to get invested in something. And so we recommend index funds. You can go to just about any place. Helpmeinvest.com will help you. We'll point you in the right direction. We'll show you. There's any number of places that you can do that. But that's part of the reason we like them so much.
Well, we do, and there are also different indexes. When you think of the Dow Jones Industrial Average, and that's been around a long time, that's just 30 stocks, and to qualify for that, you have to be a very large company and very old. And you remember when General Electric was one of the ones on that particular 30, and they were taken out when they had such a fall. And then we think of NASDAQ and the fact that that's where most of the new issues come on board rather than the New York Stock Exchange or the American. So that tends to have more opportunity, but certainly more risk.
It certainly does.
Diversification can be by size of stocks. It can be by different industries. And the the other funds, they also diversify technology, business, and then all the different areas that represent a diversity of the economy. And so it is good. Back in Acts 4, I think it is like 32, 36, that's when they began the early church, and everybody brought to the centerpiece their goods, and they combined them into one. So, and that gave them diversity even then. Then that was kind of like life insurance. You put yours in a big pool, and actuarially you have an opportunity where you can share with others the risk, and some are not going to die and some are, so there's a risk. Same thing with a fund. You diversify your money with other people, and yes, you get maybe less opportunity. You always hear about people buying a stock and it tripled and doubled and went up. They never brag about the ones they lose on.
Yeah, that's right. Everybody knows somebody that did really well on a stock, but you don't hear many about the ones that lost. They're in the corner crying over that, because
and they will.
It's not a good way to invest. For people to buy a stock, to hold it, but that's not a good long-term investment strategy. And one of the things to understand and remember when we talk about an index, and you've got these different indexes, I think I mentioned the Russell 2000. These are small. What an index is a benchmark. So it's a benchmark against that. So when you talk about capitalization in the market, capitalization has to do with the size of company. 0 to, I think, 10 billion is small cap, and 20 to, I forget the numbers, but 20 to 30 billion is a mid cap, and then you got your large cap, your blue chip. Those are safer companies. So when you're measuring against that, you have to make sure that if you're buying a small cap, you want to measure against that index. So That's what they are. And the way that they get the capitalization is literally by just the number of shares that a company has times the price of that stock on the market.
Yeah.
That's how they get a capitalization, and they say this is the capitalization of that company. And so when buying into an index, and the reason that I'm so favorable towards them and we agree that they're good, is that you're getting that exposure in not just sectors, not just, technology and electric or utilities or medical or pharmaceutical. You're getting all of that exposure, but you're also getting small cap, mid cap, large cap. You're getting, across those sectors, and you're getting across those capitalization. So it's spreading that risk, because small cap generally gives you your best return, but it's also the riskiest.
Yes.
Whereas a blue chip company that has been around for years and years, like a GE, for 100 years, is going to stand the test of the time. But even then, we can't predict when they may be delisted.